and welcome to Books for Beneficiaries. My name is Pete Williams, the host of the program on which we talk about the needs of beneficiaries. In estate planning matters, it is the estate owner that takes center stage, and that, of course, is appropriate. It is, after all, their wealth. However, the beneficiary sometimes is left in the dark as to the process. They have needs and questions. They want to ensure that they have their proper inheritance. So I am hopeful that this series will shed some light and give them some information that will help them. I call this series Books for Beneficiaries. So stay tuned for the next chapter and check back for more to come. Okay, hello and welcome to Books for Beneficiaries. Today we're going to continue to talk about the probate process. For those of you who are out there who are beneficiaries and waiting for your inheritance, I hope these episodes will help you understand what's going on. So we're going to follow up with the probate. We're now, I believe, into, if you include the introductory remarks, sort of episode 3. There's somebody has filed a petition for a probate proceeding. The petition says that, hey, here's the last will and testament, and here's who is in charge. Letters testamentary are granted to an executor when you have a will, and there's a named executor in a will. Letters of administration are when there is no will or when there's a faulty will, and there's an administrator as opposed to an executor. Just real quick, sometimes a bond is required of that executor or administrator. I will say that in most cases, a will waive bond. Bond is just putting up money or a promise of money if the executor or administrator does something wrong. So now the work began. So it sounds sort of simple, and we're going to get to some of the tangents that happen, but the job is to gather up all the assets and liquidate assets if that's the order of the will. Sometimes assets are preserved and given away in kind to a beneficiary, but often the case is that assets are sold. The executor then identifies debts and pays debts, distributes assets to beneficiaries. So what could be simpler? You get all the assets, pay the debts, and give it money to the beneficiary. How long can that take? Well, it can take long because of certain complications, as I will put forth some of them today. My message here is to beneficiaries is to be patient and understand that there's a process that you have to go through before assets can be distributed. What the executor is going to do is create an accounting and submit that to the court. And then there's going to be a hearing on that accounting. It's going to be assets, liabilities. And along the way, anybody can say, hey, wait a minute, there's other assets out there that we missed. The asset that was included was actually in joint tenants with somebody else and should not be included, or that debt has been paid, or that sort of thing. So there is a process for the accounting. The executor or administrator wants to appraise assets, and there's several reasons for the appraisal, as we'll see. We want to set a new basis for capital assets. I'm going to explain that in a moment. We want to establish sales price. We want to establish division among beneficiaries. And finally, we want to see if this estate is taxable under the estate tax, federal estate tax provisions. So number one, a step up in basis occurs at death for capital assets. All capital gains are forgiven. So let's just say that somebody bought a house for $200,000 or other building for $200,000, and over decades it has grown to $1.2 million. Now, if they sold it during their life, typically there'd be $1 million capital gain. Now, just as a little tangent here, a little aside, single-family residents have special rules and special exclusions. But if this is a typical capital asset like stocks, business property, that sort of thing, they get a full step up for the entire thing. And if the asset was sold the day before death, there'd be a large capital gains tax. At death, all that is forgiven. So we need, for tax purposes, to get an appraisal to understand what the new basis is. And if the asset at date of death is worth $1.2 million, and if it is sold the day after at $1.2 million, then there is no gain on sale, even though the asset has grown by $1 million. Another reason to get an appraisal is to set sales price. One of the things the executor or administrator does not want to do is to sell assets at below market value, because they'll get into trouble, right? If 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 a executor or administrator sells a house at lower than market price, beneficiaries are going to scream and yell about the fact that, hey, we could have gotten more for this. And this is particularly important for not only real estate, but also for collectibles. Two things. One is the executor may sell the collectibles, and that can be, say, art and jewelry. So they need to get an appraisal before they sell it. They need to sell it at a price that a willing buyer would pay for it. The other aspect of this is if the will or the executor decides that they're not going to sell these assets, but give the assets to the beneficiaries as part of their share, they need to know precisely how much those assets are worth. So Johnny gets the house. How much does Jane get? So appraisals come in when assets are divided up, not sold, but assets are handed out in kind. If beneficiary 1 gets the house, well, if the house is worth $1.2 million, then beneficiary 2 should probably get $1.2 million in cash. If there's a mortgage, the mortgage has to be deducted. Property taxes and such, those have to be accounted for. And likewise, if one of the beneficiaries gets jewelry or art, you need to know how much those are worth in order to pay the other beneficiaries their fair share. So appraisals are important, and they do take time. Often the accountant knows an appraiser, a certified appraiser. My message in this episode to beneficiaries is that I want to explain why perhaps things are taking longer than you would expect. Finally, another reason to get an appraisal is to see if the estate is subject to estate taxes. Estate taxes are taxes, they're not income taxes. The estate taxes are taxes due at death on the value of the estate. So it's important to get a good value in order to determine if taxes apply. Now, I'm only going to talk about federal estate taxes. There are some states that have their own state estate tax. On the federal level, most estates go without being estate taxed. And that is because there's a huge exemption, $15 million per person, $30 million for married couples. Now, this can change, and it has changed over the years. And by the way, the federal estate tax can be as high as 40%. So it's significant. Marginally 40%. So that's why we have an appraisal. That can delay the process of getting assets collected and an accounting done. Don't forget income taxes. Income taxes, there's really two things to think about. One is a final income tax return for the wealth owner. You know, if they die in September, they owe income taxes from January through September. And there's got to be a final tax return done. Now, the income after September is often on the estate itself, and that estate becomes more or less like an entity, like a corporation, like a trust. It pays its own tax and has its own tax ID number. This also can delay the filing of the accounting and the ultimate distribution to beneficiaries. Debts, it's on the executor administrator to determine what the debts are. They need to be determined to be either valid or invalid, paid or unpaid. They have to be known to be secured or unsecured. Secured debts are against the property itself. And so property that secures the debt is going to pay that debt. Auto debits have to be ceased. In this day and age, a lot of business is done through auto debit. Hey, sign up for my annual program, $29 a month, and I'll just debit your credit card or debit your bank account. those have to be stopped at date of death. And here's an interesting thing is that who pays these debts, including taxes, through some sort of title arrangement, pay on death accounts, joint tenancy arrangements, beneficiaries and IRAs, 401ks. So what happens if those assets pass to the beneficiary, but there's no assets in the estate to pay debts? It differs in each state, and it can be a point of argument. Hey, Johnny got the house through a joint tenancy arrangement, and now the debts of the estate are, I have to pay him through my cash that I'm getting from the estate. That doesn't seem fair. And that again can be changed and argued about and revised through the probate process. So that can take some time. Normally there's a consolidation of assets. Assets are sold and they're put into a single account somewhere to pay debts and taxes. And what's left over is paid out to the beneficiary. Often the executor has a holdback. Understand that if you're a beneficiary, the executor may say, hey, look, I'm just paying 90%, but I'm doing a 10% holdback because there might be some taxes or debts out there. So I'm going to hold back. So be aware of that. Also, this consolidation, this is where often items of sentimental value can come in. Hey, don't give or sell that couch or that piece of jewelry that's been in the family for over 100 years. And so that can slow down the process. It's kind of nice when assets are all sold, they're consolidated, put in a checking account, and they write 4 checks to 4 kids. The next best thing is that the kids get together and say, okay, well, Johnny can have, dad's war medals or whatever. We're not going to worry about that. And then they all come to an agreement, and then everything's consolidated and paid out. So that's the meat of the process that goes on. And I just want you to understand, we could have gone off in several tangents here, several complications, and I will get to those in future episodes. But I just want you to know, as a beneficiary, be aware that there may be some delays, some complications in figuring out what assets to give out. So what we've talked about today is that after the executor gets their letters of administration, they get property appraised, the executor pays legitimate debts and taxes, they file an accounting, and then the executor determines how much leftover is paid. So understand, this does take time. It's not quite as simple or straightforward as you might imagine. The executor has to be diligent, because if the executor pays a debt that wasn't owed, that may end up coming out of the executor's pocket. So just understand that the executor needs to be careful. So that wraps up. We've talked about the meat of the probate, but there are going to be some complications that are very common out there. And we're going to take those each one at a time as we go. So I want to thank you very much. This has been Books for Beneficiaries. Just remember that this information is information intended to be legal, financial, or tax advice. If you need that kind of advice, you need to find your own professional to give you that within your own jurisdiction, state, county. They've got to follow the rules. So thank you very much. And we look forward to seeing you in the next episode, where we're going to wrap this up, and we're actually going to talk about cutting checks to beneficiaries finally.